Hello, everybody. In Chapter 20, we're going to be talking about money, financial institutions, and the Federal Reserve. In this chapter, we're going to be talking about why money is important, the control of the money supply, the history of banking and the need for the Fed, the U.S. banking system, the banking crisis, and how the government protects your money, using technology to make banking more efficient, and then international banking and banking services. So these are all things that I, participate in every day with my current job with CEFCU. So, looking forward to this chapter. So the question, what is money? Money is anything people generally accept as payment for goods and services. And then you do have the barter system, which is the direct trading of goods and services for other goods and services. So the barter system, was a lot more prominent, especially in the very early days of our nation. Whereas now, it's usually not as prevalent. You still see it out there with things like Craigslist, where people are wanting to trade different things, but for the most part, everything is done with money. Although people have long used barter to exchange goods without money, one problem is that objects like chicken and eggs are harder to carry around than a $10 bill. What are other drawbacks of bartering have? So a really good example of ways that bartering can be a drawback is just like counterfeit things. So somebody might trade like one watch for another watch, and the one watch that was traded might be like a fake watch. Say it was supposed to be a Rolex, but ended up just being a fake Rolex. So that does happen with money, but for the most part, there are a lot of safeguards put into place with counterfeit dollars, especially if it's $100 bill. It's pretty easy to spot a counterfeit with those these days. But with the bartering system, a lot of the times you can run into those situations where somebody has to have like a fake, and then you get kind of swindled out of something. So continue on with what is money. So some of the standards for a useful form of money. So you have portability, divisibility. Usually, 5 and 10s are the denomination. Stability, durability. You want to make sure that it lasts for a very long time, and then overall uniqueness. You want to make sure that it's really difficult for somebody. You don't want any counterfeits made off of any sort of dollar bills. And then electric money, or e-money, is a newer form. So there are things like Bitcoin and everything, which these are not government regulated currencies. So right now, that's why they're very volatile. Where 1 week you might see that the value of Bitcoin is really high, the next week it's very low. So it needs to be some sort of acts put in place or law to address some of the issues with Bitcoin and other cryptocurrencies. But I think we're a long way off from that at this point. So newer engraved bills that make counterfeiting much more difficult than in the past. The current bills look a little different than older ones and contain a variety of colors. If you own a store, what will you do to make sure employees accept counterfeit bills? So one of the things that we do, and you see usually if you go to a gas station or Walmart or someplace, anytime you give them $100 bill, they use a marker to make sure that it is a legitimate bill. Just because if you use a marker, if it comes up brown on it, then it's going to be a good bill. If it comes up gray, then it's a counterfeit bill. One of the things that I have noticed throughout the years is sometimes that people will take, say, a $1 bill or a $5 bill, something that's lower denomination, and they can bleach it and kind of wash off all the numbers on it, and then they can turn those funds into, say, a $50 bill or a $100 bill, usually a $50 bill, because those are a little easier to get away with. So whenever you use the marker test, it won't show up as being a fake bill, even though it is in fact a fake bill. So that's one thing you do have to watch out for. I mean, you can always take a bill, put it up into the light. You can see the watermark of whoever is on the bill in it, and there's other things to look at as far as just does it have a correct number for a serial number on there? Does everything look right? For the most part, from my experience with it, is counterfeit bills, if they haven't bleached or washed, which are a very sophisticated counterfeit bill. Most counterfeit bills, somebody just tries to print on kind of like a regular paper, and it's very easy to tell the difference, especially if you're doing a lot of cash handling. So anybody who's worked, at a retail job or in any sort of banking industry and everything can probably vouch for that as well. To where there's definitely a different feel whenever you do come across a counterfeit bill. So the money supply, this is just the amount of money the Federal Reserve Bank makes available for people to buy goods and services. So the money supply is referred to as you have M1, which is money that can be assessed quickly and easily. So this is coins, paper, money, traveler's checks, etc. And then you've got M2, so this is M1 plus money that may take a little longer to obtain. So savings accounts, mutual funds, things along those lines. And then you've got M3, which is M2 plus big deposits like institutional money, market funds. So a lot of people ask, how long does paper money last? Usually, if I see like a bill from like the 1990s or something, that's a pretty rare thing, just because they typically don't last that long. So kind of some averages here. So the $1 bill usually lasts about 5.8 years. $5 bill just over 5. $10 bill just under 5. The 20-year you've got 7.9 years. $50 bill 8.5, and then you've got the $100 bill, which is 15 years. Just my speculation on the $100 bill would be just because you're not using those as frequently as, say, like a 10 and a 20. The 20 does have a pretty good time range on there, though. But yeah, for the most part, I think it was just a couple weeks ago I came across a $100 bill from like 1985, and one of my employees asked me like if it was a legitimate, dollar bill, and I had to do some research, hold it up into the light, just because there weren't those like safeguards on there, such as like the blue strip and everything that we currently have. So anytime we do have older currency like that, a lot of the times it does raise some red flags with any financial institution or any retailer that they're accepting it. So some money milestones. So in 1956, Congress set the minimum wage at $1 an hour. In 1960, we have 10 million presidential campaign by candidate Richard Nixon. So he was able to raise $10 million, which is a huge amount of money for that time. 1985, we have a $100,000 bottle of wine sold at auction at Christie's. 1995, we have $1 million cost of a 30-second commercial during Super Bowl. So now most of those Super Bowl ads will go for $2 to $3 million. So they're continuously getting higher and higher. 2001, we have a $10 movie ticket in New York, which it seems pretty cheap for now. It seems like if you want to go to the movies, it's like $15. And then 2004, you've got 100 million Picasso painting sold at Sotheby's, and then also a $1 billion stadium built in London. So yeah, as far as the stadium goes, stadiums are getting bigger and bigger each time that they're building them, and hundreds of millions into billions of dollars are being invested into those stadiums. Some other facts about money here. So in 2013, the U.S. printed 37 million bills a day. You have 95% of newly minted money was printed to replace bills that are overseas. So the ridges on coins are to prevent counterfeiting. Each penny costs 1.6 cents, and each nickel costs 6 cents to make. That's what a lot of the times you'll hear a lot of like politicians and people in government talk about, how we should get rid of the penny just because it's costing more to make than what it's actually worth, and kind of the same thing for the nickel there. So there is a lot of compelling arguments out there to say that we no longer need change, and I'm kind of for that, just because as we do a lot more with electronic funds and going to just kind of like dollar bills, we don't necessarily have that need for coin anymore. So I still think we're a long way off, if it will ever happen, to not having coin, but I'm definitely in favor of getting rid of it. And then we do have the most tracked bill on where'sgeorge.com, has traveled over 13,325 miles in 9 years. So I'm sure everybody here at some point has got some sort of bill saying where'sgeorge.com. You can go out onto the website, type in the serial number on the bill, and find out exactly where that bill has been over the years. Managing inflation and the money supply. So inflation is sometimes called too much money chasing too few goods. In deflation, prices go down because of a surplus of goods and services compared to money. Surplus a lot of times has led to like the Great Depression in the 1930s. That was a huge issue with that. And then you've got the size of the money supply can affect employment and economic growth or decline. So the global exchange of money, so you have a falling dollar value. This is just the amount of goods and services you can buy with dollar decreases. And then you've got a rising dollar value, which is just the amount of goods and services you can buy with the dollar increases. So, I think I've talked about it in previous chapters where we do, foreign currency exchange. AdSefQ and other financial institutions do it as well. And you can always see kind of like the different exchange rates, and if it's a lower rate, buy into it at that point, and then within a couple of weeks, couple of months, it might raise up. You can cash that in and then make a little bit of a profit off of it. So what makes the dollar fall or rise is the position of the U.S. economy relative to other global economies. So the impact of the falling dollar, so U.S. tourism increases, which is good for hotels, resorts, theme parks, and retailers that serve international travelers. Overseas demand for U.S. products rise, and then a favorable exchange for U.S. companies increases profit in foreign markets as well. Some basics about the Federal Reserve. There's 5 major parts with the Federal Reserve. So you have the Board of Governors, the Federal Open Market Committee, 12 Federal Reserve banks, 3 advisory councils, and then member banks of the system. So here are the 12 Federal Reserve District banks. So being here in the Midwest, we do have one in Chicago. We've got one in St. Louis. Kansas City's not all that far away. We've got Minneapolis there. So, and even in Cleveland, so right here in the Midwest, we've got say 1, 2, 3, 4. We've got 5, so that's quite a bit just for just this region. And then out west, we don't have as many. We do have San Francisco. We've got Dallas. Out east, you're looking at Atlanta, Richmond, Philadelphia, New York, and Boston. And then you do also have mints, which create the money. So there is a mint in Philadelphia, and there's also a mint in Denver. And I want to say there's another one, but it's escaping me right now. So the reserve requirement, that's going to be the percentage of commercial banks' checking and savings account that must be physically kept in the bank. So they might say that 50% of the accounts or 50% of the funds for all of your accounts must be kept within the bank. That way, if you do have a lot of customers come in and they want to liquidate their assets, you're able to give them the funds right then and there. You have open market operations, which is the buying and selling of U.S. government bonds by the Fed with the goal of regulating the money supply. So we talked about bonds, I think it was in the last chapter. And then you do have a discount rate, which this is just an interest rate that the Fed charges for loans to member banks. So how the Federal Reserve controls the money supply. So for the control method, for increasing, so banks put more money into the Fed, reducing money supply. Thus there is less money available to lend to customers. And then with this, the economy slows. As far as a decrease goes, money's put less into the Fed, increasing the money supply. Thus, there is more money available to lend to customers, and then the economy speeds up. So right now, we're kind of in a increase where we're kind of wanting to slow down the economy a little bit, whereas 10 years ago, we were in a decrease where we were wanting to speed up the economy coming out of that recession. For open market operations, whenever the Fed sells bonds, money flows from the economy to the Fed, and then when the Feds buy bonds, money flows into the economy from the Fed. With that, the economy speeds up. We have rate increases, which banks borrow less from the Feds, thus there is less money to lend. And then rate decreases, banks borrow more from the Fed, thus there is more money to lend, and then the economy speeds up. So right now we're kind of in a little bit of a gray area with managing the discount rate, just because the Feds are slowly creeping the rates up a little bit, which is wanting to slow down the economy. But most of the banks are wanting to kind of speed it up and say, we haven't fully recovered from the recession at this point. So they are doing it gradually, and I don't think we're ever getting to the point where we're going to see like super high rates again. In the mid 90s, whenever the economy was doing really well, I think the kind of average rate for like a car loan was about 6, 7, possibly 8% for a brand new car, whereas nowadays most of the loans you can get out there for a brand new car are usually around 3 to 4%. So I think the feds and banks have seen that there's huge profits to be made whenever the rates are low. So I think it's just kind of be a little bit of a give and take with the feds and the bigger banks, to where they're just kind of discuss like, hey, we need to kind of stay below that kind of 5% range for some of our rates, and then that way we can make sure that the economy is doing well all the time. So the Federal Reserve check clearing rules. So this is the function that comes into play when you write a check to an out-of-state retailer, for example. So banks have taken measures to lessen the use of checks. So whenever you do, write a check, whether it's at a retailer or you go to a bank to pay on a loan or something like that, you write your check to Chase Bank for $350. What happens at that point is they run it through their system. Then through their system, it goes to the Fed. The Fed reviews it to make sure that everything on the check is correct, and that funds are available by checking with the institution that the check is written off of. So, there's communicating between, all three parties in that situation. And usually it will take, 7 to 10 business days for the Fed to come back with a decision on it. If it comes back with, funds that, aren't available, then you might get like a return check or something like that. You'll probably get some sort of, fee for that. So that's why, in the, old days, if anybody's ever seen the movie Catch Me If You Can, that was a really good example of, how you could do, fraudulent checks and kind of get away with it for a very long period of time, just because we didn't have as many electronics and technology to help out with the feds and figuring out if a check was good or not, to where even in that movie they talk about how they only accept local checks at a lot of different places, whereas now with so much technology that we have out there, you can go and check to see if an account number, if that kind of rings a bell through different systems, make sure if we've ever seen checks like that before. So there are a lot of measures that we take to prevent fraud and make sure that we don't run into tough situations. So the check clearing process through the Federal Reserve bank system. So this is just kind of an example of like a farmer. So the buyer, so this is a farmer in Maryland. He ends up selling or is buying something from a tractor dealer in Austin, Texas. The dealer will go into their local bank in Austin, cash the check. The bank in Austin will, send it to the Federal Reserve in Dallas. From there, they'll send it to the Federal Reserve Bank in Richmond, and then it'll go to the local bank in Quincy Orchard, where the check was written off of. And then it'll hit the farmer's account. And then once the local bank there in Quincy Orchard has verified that the funds are good, then it kind of does a reverse on that. So it goes from Quincy Orchard back to the Federal Reserve in Richmond, back to the Federal Reserve in Dallas, back to the local bank in Austin, and then back to the seller in Austin, Texas, saying everything was good, and the funds are in the account at that point. So the establishment of the Federal Reserve System, there was a cash shortage problem in 1907 that led to the creation of the Federal Reserve System. Under the Federal Reserve Act of 1913, all federally chartered banks had to join the Federal Reserve. So the banking in the Great Depression, so the stock market crash led to bank failures in the early 1930s. In 1933 and 1935, Congress passed legislation to strengthen the banking system, including the establishment of federal deposit insurance. So FDIC with that. So, most accounts are insured up to $250,000 with FDIC. What had a really big play into that was, like mobsters during the 1920s and the 1930s, like, your Bonnie and Clyde, Babyface Nelson, different people like that who were going into banks, taking as much money as they could out of the banks, robbing the banks, and then they getting away. And then the people who had deposited the money into those banks, they were pretty much just out that cash. So a lot of people weren't utilizing banks at that time just because they were scared. Either one of two things: either the bank would fail and they wouldn't get any of their money back, or somebody would come in and they would rob the place and they wouldn't get their money back either. So that's why if you hear somebody talk about how they store their money under their mattress or something like that. Like that used to be a legitimate thing back in the 1920s and the 1930s, just because people were kind of scared with banks. So with the establishment of the Federal Deposit Insurance or the FDIC, that put into play that you can put money into a bank, if it's part of the Federal Reserve. they're going to be able to protect you up to $250,000 on that account. So, if the bank does fail, or if somebody comes in and takes your money, like, your money is still going to be protected under that. So, that's a really good thing that you can have. So anytime you go into a bank, you'll probably see, up around like a teller line, or even like the door coming in, there'll be like a sticker or a little sign that says, insured by the FDIC. Now, credit unions, we don't fall under the FDIC. We have the NCUA, which also falls kind of under that $250,000 limit as well. And everybody who has accounts with us falls under that insurance. So the Federal Reserve System was designed in 1913 to prevent the kind of run on banks that occurred in 1907. Yet the stock market crash in 1929 caused depositors to make another run on their banks and take big withdrawals. Federal Deposit Insurance was established in 1933 to protect depositors' money. Do you think that these protections were enough? I think overall it put some confidence back into the banks, saying that with these banks, your money is going to be insured through the Federal Deposit Insurance, and you don't have to worry about any of your funds just going away, either by the bank failing, or somebody coming in to rob the bank. So I think overall it was just kind of good perception for the government to kind of step in and protect the banks, and then protect the consumer on the other side of it. So here's some of the biggest banks in the United States. J.P. Morgan Chase, that's going to be one of your biggest banks. You got Bank of America, Wells Fargo, Citigroup, and then others that's going to account for almost half there. So here in Springfield, we do have a J.P. Morgan Chase. We do have Wells Fargo. I can't remember if we have a Citibank or not. I know we don't have Bank of America. So some of these big banks have been around for many years. They're very well established, and then they do have a lot of leading technology and a lot of funds behind them. So they're household names at this point. So it's not to say that someplace like a Bank of Springfield or a United Community Bank, or even like a SEFCU or credit unions here in town, we're not doing the same things that these other banks are doing. We just haven't been around as long. And we don't have as many assets as they do, which can be a good thing, just because you do get a little more customer service by going to your local community bank, or your local credit union. So the largest U.S. bank failures. So here we've got Colonial Bank. This was the most recent one here in 2009. So they had assets of $25 billion, and then it went under. That was right after the Great Recession. You've got American Savings and Loan in 1988 with $30 billion. So the big one there was Washington Mutual Bank in 2008 with $307 billion. Also part of that recession there. So the U.S. banking system, so the system consists of commercial banks, savings and loans association, credit unions, and also non-banks. So a commercial bank, that's going to be a profit-seeking organization that receives deposits from individuals and corporations in the form of checking and savings accounts, and uses those funds to make loans. So a commercial bank has two types of customers, depositors and borrowers. So what Americans look for in banking, the big one there, 80% of Americans are looking for mobile banking, which is becoming, a much bigger thing. And that's why you'll see, all the banks kind of out there today have, some sort of app, or, website that you can access through your phone. And every day that's just becoming a bigger and bigger thing, to where it has more features, on apps. You want low fees. You don't want to be charged. I know, one of the banks we just talked about a couple of minutes ago, Bank of America, they just came out, I think within the last 6 months to a year, and said, if you have a checking account with us and you have less than $1,000 on it, then you're going to get charged a monthly fee. So a lot of these, bigger banks are going towards that, just because, they're not as customer oriented. They're more about, they're just their bottom line and improving, efficiency. So they don't necessarily care about the person who keeps, $20 in their account at all times. They want to make sure that they're able to, have accounts with a lot of money in it, and then that just improves their, financial situation. So, safety, that's another major concern. You want to make sure that your bank or your credit union or financial institution is going to be around for a very long time. Convenient locations. Most people want a bank or financial institution that's within a couple miles of their home. That way, if they do have any issues, they can always go into that financial institution, talk to them about it. Interest rates, obviously, everybody wants a lower interest rate, especially when borrowing money. Low balance requirements, kind of going back to that low fees that I was talking about. And then, other things, do you want 24-hour service? Do you want availability to, checking your credit score? So I know, I have a credit card through Chase. I'll get an email every, 2 or 3 months, something like that, and it'll, have my credit score in it, or it'll have a link saying access your credit score here, and different things like that. So there are different services that different banks and financial institutions such as credit unions are offering. So there's pros and cons to pretty much every bank or credit union that you go to. It's just all about kind of what do you think is going to fit you best. So some services provided by commercial banks. So you've got demand deposit. So this is your checking account. So this is money can be withdrawn anytime on demand from the depositor. So just making sure those funds are available at any time somebody comes in to get those funds. You've got time to deposit. So savings account, a bank require prior notice before its owners withdraws the money. And then you've got certificate of deposit or CD. And this is just a savings account that earns interest to be delivered on a certificate's maturity date. So, most CDs, they can range anywhere between 3 months and say 5 years. And they can just provide a little higher interest rate than your typical kind of savings account. If you do get, say, like a 3-month CD, maybe you're only going to get 0.5% return on that, just because that is such a short amount of time. Whereas if you go with like a 5-year CD, maybe you could get like 3, 4, possibly even 5%, depending on the financial institution, what they're offering at that time. So, certificates of deposit are always a great way to get a little more bang for your buck. Like I said, you can always call into your local bank or your local credit union. They'll be able to give you any sort of rates on certificate of deposit. That does change usually on a weekly basis, and it kind of depends on what the feds set the rate at, and then banks and credit unions will adjust their rates according to what the Fed is kind of saying for that weekly basis. So we do have a lot of people who will come in as FQ on a weekly basis and check our rates for the certificates. So other financial institutions always run different types of specials for certificates as well. So it's not very risky. The only thing with it is you just have to put that money into that account and just keep it in there for that term, whether it's 3 months, 5 years, whatever it might be. If you take it out before that, you'll probably incur some sort of penalty on it. So that is the downside to it. So down here, so service to borrowers. So loans are given on the basis of the recipient's creditworthiness. So loans, that's something I deal with on a daily basis. A lot of people just think that whenever we take a loan and look at a loan, we're just looking at credit score. That's not the case at all. I mean, a lot of the factors that we take into consideration are time on the job. What's your debt to income ratio looking like? When I say debt to income ratio, that means that the debts that you have out there, they don't exceed a certain threshold for what kind of income that you're making. Meaning if you make $50,000 a year, or let's do $60,000 a year because that makes a nice even number for a monthly income. That means you're making $5,000 a month, and then say you have $2,500 in debts, and so those debts include your mortgage, your car payment, any credit cards, any other type of loans that you have out there. So at that point, your debt to income ratio would be 50%. So that's just saying that 50% of the money that you're bringing in is going towards your debt. So that would be an extremely high debt to income ratio. Typically you want to have something 30% or below on that. So that can be a really good thing to look out for whenever you're trying to plan. If you are going to be getting a mortgage or a car loan or everything like that, take a look at your debt to income ratio and kind of figure out, are you in a good spot financially, and then you can kind of, figure out what might you be able to afford whenever you are looking for like a car payment or a mortgage. You can always go into, a bank or financial institution and talk to them as well whenever you're putting out an application, and they'll be able to help you out as far as determining an affordable loan payment. So you've got the Savings and Loan Association. So this is a financial institution that accepts both savings and checking deposits and provides home mortgage loans. So this is often known as thrift institutions because their original purpose was to promote a customer thrift and home ownership. You got credit unions, which is something that CEFCU is. Other local credit unions here in Springfield. We have Heartland, and then there's also Credit Union One. There's a couple locations here. You also have some, smaller credit unions like the state police. They have their own credit union. So usually, a lot of the times, credit unions get started by, an employee group or a small organization, and then they build up from there. I mean, that's how CEFCU got its start. Was started out as a credit union for Caterpillar employees, slowly grew from there, and now we are what we are today. So credit unions, not-for-profit, member-owned financial cooperatives that offer a full variety of banking services to their members. And then as nonprofits, credit unions enjoy an exemption from federal income tax. But that's not to say that we don't pay any taxes. I mean, we still do pay, taxes like on properties and different things. So other financial institutions or non-banks, so financial organizations that accept no deposits but may offer the services provided by regular banks. So non-banks include life insurance companies, pension funds. So for pension funds, this is the amounts of money put aside by corporations, nonprofit organizations, and unions to cover part of the financial needs of members when they retire. So pension, that's always a really big topic whenever we're talking about Illinois employees, just because their pension fund is not in the greatest situation right now, but private organizations also do have pension funds as well. Most organizations will usually offer a pension to somebody who's been at the organization for 5 years or longer. So after that 5 years, even if you quit your job after 5 years, you can still be vested in that pension, and then that way, whenever you do retire at say maybe age 65, you can still get maybe $50 a month, $100 a month, whatever it is at that point. You've got brokerage firms, commercial finance companies, and then corporate financial services. So who's responsible? Some believe the Fed kept the cost of borrowing too low for the banking crisis. Some believe the Congress pressured banks to making risky loans. Banks divided portfolios of mortgages and sold mortgage-backed securities, and then some believe the Fed and Securities and Exchange Commission failed to issue sufficient warnings. I believe we talked about this in the last chapter, maybe the one before that, maybe chapter 18. Like I said at that point, I think it was just kind of the perfect storm where, the government, they kind of relaxed some regulations. The banks were kind of taking a little more risk on it. It wasn't just one person that was responsible for, the banking crisis in 2008. It was everybody was to blame at that point. We got through it luckily, but, it definitely wasn't the easiest of times. So, the housing bubble, so the bursting of the housing bubble in 2008 forced a sharp decline in home values when homeowners discovered they owned more on their mortgages than their homes were worth. Many stopped paying off their loans. As a result, the banks foreclosed on the houses. While some prices have since risen in many areas of the country, some areas have been slower to recover. How is the housing market fared in your hometown? I think for the most part, Springfield did a pretty good job of kind of bouncing back. It did take several years. But for the most part, we are seeing pretty good values on the homes here locally, not just in Springfield, but in central Illinois altogether. So as far as protecting your funds, we talked about, FDIC. So this is an independent agency of the U.S. Government that insures bank deposits up to $250,000. You've got the Savings Association Insurance Fund. This is part of the FDIC that insures holders of accounts in savings and loan associations. And then I talked about this as well, which is the NCUA, which is National Credit Union Administration. This provides up to $250,000 coverage per individual per institution for credit unions. We have some technological advances. So we have electronic funds transfer, or EFTs systems. So this is a computerized system that electronically performs financial transactions such as making purchases, paying bills, and receiving paychecks. Every financial institution is going to be offering these days. Think about your debit card. If you have direct deposit from a job, if you do like any sort of like bill pay, through your online account, that's all going to be covered under EFTs. Covering over here under debit card. So this serves the same function as checks. It withdraws funds from your checking account. You can also have it linked to your savings account. most institutions will kind of limit how many transactions you can run off of your savings account if you have your debit card linked to that. That's why most of the time it's a better option to just have it linked to your checking account. You've got a smart card, which is a combination of a credit card, debit card, phone card, driver's license card, and more. These are kind of still a concept at this point. I know there's a couple other, companies that are getting on board with this and trying to make it a bigger thing. To my knowledge, not many financial institutions are kind of doing this right now. We still have, multiple cards, whether it be, a credit card or a debit card. Mobile banking. I don't know if anybody uses, Apple Pay. Or Google Pay, Google Wallet, different things like that. I know I've used Apple Pay quite a bit. You can link your debit card or your credit card to your phone, and then you can just pay at a lot of places just with your phone. So I think there's probably going to be a higher demand for mobile applications rather than the smart cards. But I think at some point probably smart cards might play a little bigger role. So other conveniences include direct deposit and direct payment. You can also set up ACH, which stands for automated clearinghouse. If you want to set up, say you have an account at SEFCU and you're wanting to pay, a bill at Chase for like a car loan or something like that, you can set up a ACH, which is just like an automatic payment coming from SEFCU to go to Chase to pay that bill. So RFID chips, we've talked about RFID in the past. So these chips and credit cards allow consumers to pay for products with just the wave of a hand. They're also easier for hackers to access, leading some people to keep their cards in RFID blocking holders like this one. So how do you make sure that your identity and finances are secure? The number one thing you can do is just make sure that you're protecting your identity by not giving out personal information. I've talked about this in the past. I mean, it's always a good idea to get like a shredder for your home. Then that way, if you do get any bank documents or financial records or anything like that, once you're done with them, you can either file them or you can shred them, and then that way people can get your information from that. I always say it's probably a pretty good thing to if you're buying something online. Especially if it's kind of like a shady website, you can use a credit card instead of a debit card. Both a credit card and a debit card are going to have liability services with it, to where you're not going to be liable for any fraudulent charges on it. The thing with the credit card is if your information does get hacked and they run up a big charge on your credit card, you're not going to be liable for it. You don't have to pay for it there. Whereas if it was on your debit card, they could wipe out your checking account within a day, and then you're just kind of left there, standing with no money in your account, and it could be a couple of days before the money's into your account. So that's why usually if I'm buying stuff online, I usually use a credit card, just because I don't want my account to be drained if I do end up getting hacked. And then, with a credit card, it's not going to be a big issue. I mean, if I have to make like a minimum payment or something like that, that's not an issue, because a minimum payment is usually going to be, pretty small. And then, if it does end up taking, a few days for everything to kind of get, fixed at that point, I'm not going to be liable for any of those charges anyways. So cash, check, or charge. So how Americans prefer to pay. So, credit card, 92% of Americans prefer to go with a credit card. We've talked about that in previous chapters. So, credit cards are great. I just talked about how, they can be a little bit better, for like online purchases and just making sure that you're not on the hook for a lot of the stuff. But at the same time, a lot of Americans just use their credit cards too much, and that's why they get into a lot of credit card debt. Cash, I still say, cash is king. We do have a lot of people in this country that still prefer cash over any sort of cards. Venmo, that's becoming a bigger thing. Online application. I love Venmo. It's a great app to use, especially for sending money back and forth between friends. I use it quite a bit during like March Madness. If I'm like in an office pool, or if I'm in like a bracket with like my friends or something like that, we can just send $10 to each other through the app on that, and then you can also link it to your account. Talked about Apple Pay and Android Pay, Google Wallet. You do have PayPal, which is still relevant, and then down here you do have checks, which I would highly recommend not using checks, just because there's so much information that you can put on a check. Such you've got your account number out there. Most people have their address out there, so I mean those are really good ways that fraudsters can look at a check, take all of your personal information, and able to hack your account. So they're not very secure. So making transactions in other countries. So you got a letter of credit. This is just a promise by the bank to pay the seller a given amount if certain conditions are met, and then you have a banker's acceptance, which is a promise that a bank will pay some specified amount at a particular time. And then you've got the money exchange, allows companies to go to a bank and exchange currencies to use in a particular country. So I talked about that a little bit earlier in the chapter. You've got the World Bank, which lends most of its money to less developed nations to improve their productivity and help raise standards of living and quality of life. And then you also have the International Monetary Fund, which fosters cooperative monetary policies that stabilize the exchange of one national currency for another. So about 189 countries are part of the IMF. And then we've got protests against the World Bank and IMF. So the World Bank and the International Monetary Fund are intergovernment organizations that help support the global banking community. Both draws protests for their actions. Why? Anytime you're dealing with intergovernmental or international organizations, they're probably going to be a little controversial just because, they might side with one government or one country over another, especially if that government or a country, does something a little bit shady. So a lot of times you can get, a lot of drawbacks for that. So that's all I've got for chapter 20. This is our last chapter, so I want to thank everybody for watching this semester. I hope you enjoyed these videos. If you do have any questions or anything in the future, you can always reach out to me through email. So thanks.